and I am coming to you live. We're going to be talking about maximizing tax deductions, red flags, and advanced tax strategies. So, thank you for being here with me today, and happy Friday. I am not going to take a lot of your time this Friday morning, but I did want to come to you so we can kind of wrap up our tax deduction series. So, if you are new here, we've been talking about tax planning, and we've been going through my 6-part tax planning framework. And I'll go over that briefly with you all right now just to jog your memory. So, first, we started the series talking about entity structures. Then we discussed accounting methods. And now we're on the third part, which is maximizing tax deductions. And we've been talking about that all week because there's so much to maximizing your tax deductions. The fourth part is maximizing your tax credits and incentives. Fifth is retirement planning, and sixth is advanced tax strategies or loopholes. So that is the 6-step tax planning framework. If you do want to kind of reference to these, I do have a freebie for you. You can get that. Facebook and YouTube is going to be in the caption below. Instagram is going to be the first link in my bio. It's the tax planning framework cheat sheet, and it's going to list and it'll briefly explain to you that 6-step framework that you can use to review your tax return to see if you have any room for tax saving opportunities. Also, remember, I do have some spots still left in August. If you want to take advantage of the free tax strategy session that I am offering to you, that is a 30-minute call with me where we go over your tax return to see if you have room for improvement to save more money in your tax profile, if you can save more money in taxes, if you could lower your 2020 tax bill. So please go ahead and book that. Instagram, that's going to be the second link in my bio. Facebook, YouTube, you have the link in the caption below as well. So take advantage of that. Slots are going quickly. I may even decide to open up my maybe a half a day on Saturday just so I could fit more people in. But the weekday slots are filling fast, so please take advantage of that. I know we all want to save more money on taxes. I'm just going to help out the lighting real quick, guys. I'm going to turn these lights off behind me. So that's better. That's better. All right, so let's get into some red flags. Let me first explain what I mean by red flag. Red flag meaning if you were to report a certain thing or item or a certain tax position on your tax return, would the IRS pick up on that and audit you for that reason? Right? And so does it exist? Does the IRS do that? I can tell you yes. Okay. I spent the first 8 years of my career at the IRS as a revenue agent, an auditor. And I examine the tax returns of small to mid-sized businesses as well as their owners. And there are definitely red flags. The red flags are not identified by the agent. It's identified by the algorithm that the IRS uses when they scan in the tax return. So when you e-file, it goes through the computer processing system at the IRS, and the algorithm they use will pick up on the items on your tax return, flag it for audit, and it'll be sent to an agent, which is what I was, to be audited because of specific reasons. And so the red flags I'm going to briefly go through today, there are red flags that I experienced while I was there. These are red flags that I'm still in contact with some of my colleagues that they may passively mention in conversation. These are red flags that as a tax professionals with my own clients and those that I represent in audits, that I've seen the revenue agent really hone in on and maybe even explicitly say, this is the reason that, the material reason that you're being examined. And this is just me keeping up with tax news, which I know you all don't do. Why would you? You're not tax professionals. But let's get into it, okay? So the first red flag I want to talk about that I think Hello, Wendy's Beauty Bar. Thank you for joining me. We're going to be talking about red flags today, so you really joined in when it's going to get really good and juicy here. So the first red flag that will encourage an audit, especially with the IRS, is large swings in income or expenses. And the reason why this is important is because you want to be able to audit proof your return, right? So if I'm giving you these red flags today, you can kind of make a note of them and you can say to yourself, okay, if I know that I'm going to be reporting this in this manner on my tax return, I'm going to audit proof it now. I'm going to get ready and have my ducks in a row and have all the documentation I need to support this tax position. I'm going to get that together right now, because audits do not come fast. They usually come a year or two down the line. The IRS has 3 years from when you filed your tax return to audit you. So this could potentially come 3 years down the line. You don't want to be audited and have to remember things from 3 years ago. The most effective and efficient way to audit proof your return is to get the documentation together now and just have it saved in a place. So if it happens, you're going to be ready, right? So that's why it's important to know what the red flags are. In no way am I going to say to you, these are red flags, so don't do it. No, that is not the point of this discussion. The point is so that you can be ready to support the position if it's legit and if you get audited. Now, if you hear something and you know you're doing it wrong, hopefully you can use this information to course correct, right? Before you make a huge mistake. All right, so the first thing, large swings in income and expenses. So if you went from making $50,000 in 1 year, and then the next year you made double that, $100,000, you probably thinking to yourself, why would the IRS be mad at that? I'm getting taxed more, right? This is the way the IRS is going to think. They're going to think backwards. They're going to say, oh, you made 100 grand this year? Did you really only make 50 years before then? How was it that you doubled in the year after? Maybe we should audit the year before. That's how they're going to think. So be prepared to explain the huge jump in income. On the flip side, expenses. If you went from reporting an expense, say, let's say travel, which is a very high abuse tax deduction. You only traveled, you spent maybe $2 grand on travel last year. But this year, for whatever reason, now you spent $10,000 on travel. And then even more, let's add a little something colorful to this context here. Let's say you spent $10,000 in 2020, and we know that we were going through a pandemic where there were travel restrictions. That may be a bit unbelievable, but it may be legit, right? Let's say we're going into the third, fourth quarter of the year. It's actually getting better. Travel restrictions are getting better. So maybe you just made up for the travel that you planned to do in the early of the year and the second half of the year, and then it went a jump in. It was legit travel. Get your documentation together to make sure you can explain the jump in income and the jump in expenses, especially for a high abuse area such as travel. It may just look funny on paper, and when I was an auditor and I would see these huge swings, I would immediately know what I was going to audit. However, you can't get the proper context and the narrative and the supporting documentation just from the tax return. And so when you're in an audit, you're going to offer that stuff right away. And you're going to do that because you audit proofed your return, because you knew there was a huge spike in this income and or expense. Okay. If you guys have any questions on anything I'm going to go through, because maybe you're going through it right now or have, please feel free to drop me a comment or a question. Let's use the question feature in Instagram, and then on Facebook and in YouTube, you can obviously just write them in the comments. But please stop me while I'm going on, because I could just keep going and going and going. Okay, so red flag number 2, cash intensive businesses. Okay, so for the most part, in my experience, I've seen that salons and spas and other beauty professionals, you guys are using electronic means of being paid. But there are still some salons that are very, very cash intensive, especially my barbershops, because the barbershops are not, their typical transaction is not really that high that they may pull out a card for it. They may very well still use a ton of cash. So that's a red flag for the IRS. It is, always has been, I think always will be. Just because when it comes to cash, there is no electronic audit trail. So it's really easy. Okay, if the barber got, I don't know, let's say he made hundreds of dollars in one day, it's very easy for him to just pocket a little bit, and that could completely avoid tax, right? What I would say for the cash intensive business, number 1, make sure you have a business bank account and you keep your personal and business finances separate. The minute they are commingled, the IRS has the leeway to go into your personal account and they can reconstruct your income. They can go into actually all of your accounts, business, personal, credit cards, any asset account you may have. They can go into and reconstruct what they think you made if you're commingling. Because if you're commingling, they're not going to trust your records. But if you have them separate and you show that, they have more trust into what you're giving them as to what you've made, even if you're cash intensive. But the minute you commingle, the minute they find out you commingle, it's fair game for them to figure it out themselves. Okay? So cash intensive business, make sure you have different business and personal accounts. Make sure you are doing bookkeeping. Your business account will support your bookkeeping. If you have books and records, meaning an accounting or bookkeeping system in place, and you can hand it to the agent, they don't have a reason to go to your bank account. But if you don't have that, now they have to go into the bank account. So please have a bookkeeping or accounting system in place so that they know you have a professional, legit, put together, business-like way of accounting for all that cash you're receiving. Okay? All right, so let's move on. Home office deduction, and we talked a bit about this the last time I came on, and we were talking about some misunderstood deductions. Home office is the biggest one. Everyone thinks that if you have a home office on your tax return, that's immediately audited. That is not true. That is not true. And I highly encourage you that if you have a business and you actually have a space within your home that you regularly and exclusively use to manage said business, for you to take the deduction, because it completely saves you money. And I don't want you to miss out on any money. But the red flags about the home office deduction, it really lies in, like I said, proper context. It's all about proper context with these red flags. It's not one issue in it of itself that gets you audited, that red flags you by the audit system at the IRS. It's always, okay, this issue within a bigger story. Okay? So if you had a home office deduction, part of that deduction, part of the computation of the deduction is, okay, how much of your home are you using for your business? A very, very high business usage percentage is a red flag. If you say I'm using 75% of my home for my business, that's a red flag. It's odd. It's unusual. That's large. It could be true. And if it's true, I encourage you to have all your support and documentation ready to be able to prove it. And if it's true and it's legit, I say still take it. On your tax return, it's a bit aggressive, but if it's true, I say take it. However, it is very large, unusual, and questionable that you would use 75% of your home, especially if you have a family, for your business, especially, I won't say especially as a beauty professional, because I do have clientele that, they're making their own products. And so they have a ton of inventory everywhere, right? If they're a solopreneur and they're just starting out, the house, the apartment is like the manufacturing and distribution and administrative and marketing. The whole apartment, right, that may be just 800 square feet is the business. So it could very well be true. However, just have your ducks in a row on the home office deduction. Okay, let's talk about cars. Let's talk about cars, using cars for business, which you can do, and I highly encourage it. We talked about this the last time about record keeping and making sure that you're keeping mileage at the time that you are using your vehicle for business. You do have the ability in the tax law to reconstruct documents if you're ever examined and questioned on it. But like I said before, you are not going to remember something you did 3 years ago if you're audited. So I highly encourage you, take the deduction for your vehicle. However, make sure you keep up with the mileage records. But the red flag when it comes to using your vehicle for business is just like the home office deduction. 100% usage of your vehicle is for your business. It's not true. You're gonna go grocery shopping. You're gonna go shopping for clothes. You're gonna take your kids out for entertainment. You're gonna take yourself or your spouse out for entertainment. You're gonna travel. You're gonna go all these miscellaneous places pertaining to your personal life that has nothing to do with your business. So it cannot be possible that you use one vehicle, your only vehicle, 100% for business. If you look at the tax return, the Schedule C that's attached to your 1040, right? So not the S corp and the C corporations or the partnerships. This is just the Schedule C I'm using as an example. There is literally a question that says, is this your only vehicle? Is there another vehicle available for you? There is a question that says that. Why are they asking that? Because they know if that's your only car and you do not have access to another vehicle, there is likelihood you're going to use your only car for your personal life. Now, if you are let's say you're a 2-adult household and there's 2 vehicles, is it possible you can only use one for your business? Oh yeah, that's possible. But have that documentation in place in the case you are ever questioned on an audit. Okay, let's go to the next one. A history of large deductions, no income. Now, can that happen a year, 2, maybe even 3? Absolutely, especially if you're first starting out. But after that 3rd year, year 4, 5, 6, 7, and so on, no way are you running a business that's carrying losses, prolonged losses, year after year. And let's put this in proper context. Let me make this example a little more practical. Let's say you have another job. Or no, let's say you're the beauty professional, but you are married to someone with a W-2 job. So the losses that your business is generating is decreasing the income of your W-2 spouse, essentially making you pay less tax because your beauty business is running a loss. That's a red flag. IRS is going to think, okay, this is not a business, it's a hobby. Or even if it is a business, you're just using it to offset the income from this other high earning W-2 person in your household that you're filing your tax return with. So is it possible, especially if you're first starting out or you're smaller, is it possible to run a loss year 1, 2, and 3? Absolutely. You're just starting out. You're a startup. You're in a startup phase. And the IRS knows that. There is a part, and there's a section in the tax law where it talks about the hobby loss rules. And it says that you have the ability to say, okay, IRS, I know I'm running a loss in 1 or 2, but don't audit me. Don't deny this loss. It's legit. It's not a hobby, it's a business. So just give me time to show that. And there's literally a form you can file to make this declaration. So keep that in mind. These next three are big ones, especially for my corporations. So my S corporations and my C corporations. This next one is huge. Okay, number one, if you have employees or independent contractors, a huge red flag for the IRS is worker classification. How are you classifying your independent contractors versus your employees? So the story behind this is the IRS says, okay, if you're an independent contractor, you're probably giving them the form 1099. 1099. And that form changed this year. Usually it was a 1099 miscellaneous. Now it's the 1099 NEC, non-employee compensation. Okay. If you were an independent contractor, you issued those people, the owner of the beauty business will issue those folks a 1099. You did not have to pay, you did not have to withhold any federal tax, state tax, and you did not have to pay unemployment, Medicare, social. You didn't have to pay anything. And so lots of people said, okay, well, classifying you as an independent contractor because one is less of an administrative burden. You don't have to have a payroll function in your business. And then two, save money because you don't have to pay the employer portion of the taxes, payroll taxes to the government. Well, the government says, no, you can't get off that easy, right? If you are doing certain things, if you have a certain relationship with these people, they are employees and they have rights, and you should be withholding and paying a portion of the employment taxes on their behalf. So like if you have a certain control over the person in your beauty business, that will show the IRS, okay, if you have a certain control in a certain relationship in which this person, the worker, has to adhere to your policies in a certain manner. They are not independent. They are your employee. They will come in, the IRS will come in, it will audit you, recategorize all the money you paid the worker to be employment wage that should have been reported on a W-2, and will say that you have to pay all the back employment taxes to them, plus penalties, plus interest. It's a huge issue. It's a huge issue. If you just Google worker misclassification, you will see a ton of recent tax court rulings where employers are being severely punished for misclassifying their workers. There is a 20-part test. We are not going to go through that today on this live. However, if you have workers and they are, let's say maybe you have them as employees, maybe you want to review that relationship. Review that against this 20-part test and see, hey, maybe things have changed. Maybe they can be 1099. Maybe you can save money on paying employment taxes. Or if you have 1099 workers, maybe you want to review the relationship you have now because it could have changed. Maybe they came on some way and the relationship has changed to be something else. You need to reevaluate what it is now against the 20-part test, because maybe they should go from 1099 to being Form W-2. That's a big one. Okay. The next one, unreasonable compensation. So let's say you're an S corporation owner. You should be on your corporation's payroll as an employee. Not only that, you should be paying yourself a reasonable wage. What do I mean by reasonable? That dollar amount is not determined by you. Usually, in my firm, when I do this for clients, I outsource that research to a firm that specializes in knowing what reasonable wage is for certain occupations within our country. The story behind that is IRS says, okay, likely if you're an S corporation, you did it so you can save on self-employment taxes, right? So, however, we don't want you to pay yourself unreasonably low to minimize your portion of the self-employment tax and then take most or all of your money out of the business tax-free from self-employment tax as a distribution. So if the IRS sees a tax return of an S corporation with the owner with a very, very low wage, but very high distributions, avoiding self-employment tax, that's a red flag, because we say, okay, you're doing this to avoid paying self-employment tax. Now, if you have done the research, and this is a very complex research activity where you are surveying what you pay yourself in your salon or spa or whatever your beauty business is, and you compare that to the entire country and where they are and their size, it's a lot of factors that go into the research activity, and you are legit, you got to have substantiating compensation. IRS is going to come in and they're going to say, okay, show us your research findings. And they can be, okay, well, I asked my friend, or I asked the school that I went to, or I asked my alumni association. None of that's going to fly. None of it's going to fly. So take a look at your S corporation tax return. Take a look at your the tax return and your Schedule K1 and see what your wages versus your distributions look like. Okay. The last one I got for you guys, the last one I have for you all is running personal expenses through the corporations. We're still on our S and C corporation owners. Now, remember when you were in a Schedule C, if you ever were a Schedule C, you could take like the home office deduction, the business usage from a personal item. Just like your car, you can deduct the business usage from a personal item, your cell phone, your laptop, several things, right? You can carve out the business part and you can deduct it. Well, it's much more complex when you get to the corporation level, because now you are in a different entity from yourself. Your business corporation entity is way different from you. So you can't just have the business pay for your personal things, even if you use it for business. You can't do it, and I see it happening all the time. If you were to get examined, when you're if you go through, get the tax return through the IRS algorithm, they get flagged is because they saw things on the tax return that on paper look personal in nature, and they said, okay, this person appears to be running personal things through the business. What the IRS is going to come in and do, they're going to say, okay, let me see your accountable plan, your reimbursement policy. And let me see, not only let me see the policy, but then let me see the documentation throughout the year that you, personal owner, provided to your C corporation or S corporation to be in reimbursed. And then they're going to look for the audit trail. You got to have an audit trail as well. So it's not just like, okay, I use my home office deduction, I'm just going to use the company S corporation card to go ahead and pay for that. No, there is a complete process that needs to put in place prior to that and reimbursement from happening. That's a major red flag to the IRS. Major red flag. There are many more red flags, but those are the biggest ones I have for you today. If you have any questions, please let me know. If you're shy, feel free to DM me and we can connect. We can talk about the specifics in your situation. What I do want to say, though, when it comes to red flags, even if something is a red flag on the list that I've given you information on today, if you have any of that, but it's legit, still take it. In my experience, we are very passive when it comes to tax deductions, and we cannot be, because we're scared of the IRS. Number one, don't be scared of the IRS. I used to work there. I worked there for 8 years. I went through all the trenches, went through all the training. I'm not scary. And I wasn't when I was there. I was just doing a job. So do not be scared of the IRS. There are people too, and sometimes they get it wrong. So if you see something and you can take it, I say be aggressive and take it. Just make sure you audit proof your return and have all your supporting documentation in place in the case that you get examined. The IRS audits less than 1% of all the tax returns in the country. So your chances of being examined are very, very low. But when it happens, it happens. So just be ready for it. Be aggressive. Take that deduction if you know you spent the money in your business. Just have all your records in place. So that's I'm going to get off my soapbox about red flags right now, okay? Let's get into an advanced tax planning strategy. And I want you guys to take this and keep, if you get nothing else from me, take what I'm about to say next and use it in your business on a daily basis. Okay, so here is my spiel. Having a business is one of the best tax shelter opportunities for us. Because when it comes to tax deductions, if you could tie whatever you're doing, whatever activity into your business, it's tax deductible. I don't care what it is. I do care what it is. It can be illegal, okay? It can be illegal. And hopefully it's ethical too. So, I won't say everything. I'll say most things. Most activities, if you can tie it to your business, it is tax deductible. And I know those are just like, that's just a sentence I said. And you're probably like, how is this advanced tax strategy? Because think about it. Okay, let me give you an example. Let's say you are, you want to go on vacation. I know I want to go on vacation. It's been a tough year. Several things has happened in like the first 6 months of 2020. So you are going to take this vacation. But then you think to yourself, okay, is there something you can do pertaining to your business wherever you choose to go? I don't care where it's at. Is there something you can do to tie your vacation into your business? Can you go visit another city and state and look at possible future locations for your business? Is there a client, a distributor, a possible business partner, a potential investor, wherever you're going, that you can meet up with in person to talk about your business? Is there a piece of land or a building you want to check out? Is there another piece of your business, maybe another offering, another product you want to sell, another service line, just an additional stream of income, and you want to investigate, and someone or something can help you where you're going? Can you do that while you're on vacation? All of a sudden, a portion of your vacation just became business related, and all the costs associated with that has just become tax deductible. And you can do that with a lot of things. On a very, very small level, a person, I've seen this, a person on a daily basis will go to Starbucks. We always go to Starbucks. I mean, when they were open, we would go to Starbucks, we'll get our drink. All of a sudden, you're in line, you start networking, as we often do. We're small business owners. All of a sudden, we get into this conversation with this person in line about our business, what we do, how we do it, how can we help them, what's their situation, what would you like, what's your goals. All of a sudden, y'all done got y'all drinks from the counter, y'all done sat down at a table, y'all still talking. Y'all done put out notebooks, y'all done put out pens, or maybe you opened a note on your phone. Now y'all doing this, y'all looking at calendars, y'all finna schedule follow-ups. That has just become a business trip. The mileage to Starbucks, the mileage home from Starbucks, the coffee, the pastries, it has all just become deductible. It didn't start that way, but it ended that way. So it involves creativity. It involves a little, a little thinking ahead on your part. But if you're gonna do it anyway, you might as well see how it can be reclassified to business, and then you can take the cost on your tax return and therefore save money on something you was gonna do anyway. It doesn't get more advanced than that. If you can take something that you were gonna do anyway and reclassify it, take it from personal bucket to business bucket, deduct that cost. Make sure you have all your documentation to support the cost, but take that on your tax return. That's all I got today, guys. It's Friday. It's the weekend. We've been going for about almost 40 minutes. I'm going to let you know because I know you got to finish strong. Hey, Regina, thank you for joining. That's all I got. Before we go off, though, if you have any questions or comments, if you have anything you want to talk more about, feel free to DM me. We can connect. We can talk it out. Get the freebie, the tax planning framework freebie. It lists all the 6 steps of my framework, and it gives you a description of how you can use that cheat sheet to review your tax returns. Get that. That's going to be the first link in my bio. Instagram is going to be in the caption, YouTube and Facebook. And then please, guys, don't forget to book your free tax strategy session with me. Slots in August are filling up very, very fast. I think I'm going to open up like a half day on Saturday just to give more availability because the calendar is filling up pretty fast. But book that as soon as possible so we can see if we can save you some money on that 2020 tax bill and beyond. All right? So thank you again for joining me. Have an awesome weekend. I'll see you early next week. We're going to be talking about maximizing tax credits and incentives next. Remember, credits are better than deductions. They save you money dollar for dollar. All right? So have a great weekend. Thank you.